Welcome back to our Payments Industry Masterclass. In this chapter, we're diving into the business engine that keeps the digital payments ecosystem running, the merchant discount rate, or MDR, and the revenue models surrounding it. This is where money meets infrastructure. So let's break it down. What is MDR? At its simplest, the merchant discount rate, or MDR, is the fee a merchant pays every time they accept a digital payment through a card, a wallet, or any other electronic method. Think of it this way. When you buy a coffee for Rs 100 using your credit card, the merchant won't receive the full Rs 100. Instead, a percentage, say 2%, is deducted as MDR. The merchant gets Rs 98, and that 2% is split between different players in the payments chain. Now, the real question is, who gets this money? Why is this fee charged? And how is it calculated? Let's explore that. Why MDR exists. MDR exists because every card transaction requires a set of services to work: verification, authorization, risk management, fraud detection, clearing, and settlement. Each player that facilitates these services, from the issuing bank to the acquiring bank to the payment processor, expects compensation for their role. MDR is the pricing mechanism that keeps the entire engine running. Stakeholders involved in MDR. Let's take a quick look at all the players involved in a card transaction and how they are compensated. Issuing bank. This is the bank that issued the card to the customer. They take on risk, provide the credit line in case of a credit card, and authorize the transaction. Their compensation comes in the form of an interchange fee. Card networks, Visa, Mastercard, RuPay, Amex, etc. These are the rails over which the transaction data travels. They charge a network fee and sometimes a switching fee. Acquiring bank, this is the bank that works with the merchant and provides the infrastructure, POS machines, online gateway, etc. They earn a part of the MDR for onboarding and servicing the merchant. Payment gateway, processor. This is the tech platform that enables the actual transaction. It connects the merchant, card network, and banks in real time. They earn a fee for facilitating the transaction. How MDR is split. Here's a simplified breakdown of a 2% MDR on a transaction of Rs 100, interchange fee to issuer 1.2%, network fee to card network 0.2%, acquirer margin plus gateway fee 0.6%, total MDR 2%. Now, this is not always a fixed structure. The exact percentages may vary by market, card type, merchant category, and even volume of transactions. Let's break down each component. Interchange fee? This is the lion's share of MDR and is paid to the card issuer. Why? Because they take on the risk, especially in credit card transactions, and manage customer relationships. The interchange fee is determined by the card network and usually depends on type of card. Premium cards like Platinum or World Elite often carry higher interchange fees. Merchant category. Fuel, utilities, and government payments often have lower fees. Luxury and retail have higher ones. Type of transaction. Card present, physical swipes often have lower fees than card not present online due to fraud risk. Region fees vary from country to country. Network fee. The card network, like Visa or Mastercard, charges a small fee for routing the transaction securely between the acquiring and issuing banks. This fee is typically in the range of 0.1% to 0.3%. These networks also charge assessment fees and switching fees depending on the transaction type and volume. Acquiring bank and payment processor fee. The acquiring bank bears the cost of setting up and servicing the merchant. This includes POS terminal or gateway setup, KYC and compliance, fraud monitoring, customer support. The payment processor also needs to maintain real-time transaction capabilities, API infrastructure, and settlement systems. They share a part of MDR, either as a fixed amount per transaction or a percentage. Types of MDR models. Now let's talk about how MDR can be structured. Standard MDR, a flat percentage, like 2%, applied to all transactions regardless of card type or volume. Tiered pricing, different MDRs based on card types, debit, credit, commercial, or risk levels. For example, debit cards may carry 0.5%, while premium credit cards may have 2.5%. Interchange. Plus, some processors offer transparency by showing exact interchange and network fees and then adding a fixed markup, say 0.3%. Blended pricing. All costs, interchange, network fee, processor fee are combined into a single flat rate. How MDR affects businesses. For large businesses, MDR is often negotiated at lower rates due to high transaction volumes. For example, a retail chain processing millions in monthly sales may pay 1.2% MDR instead of 2%. On the other hand, small businesses and startups often pay higher rates due to limited volume and higher perceived risk. Many businesses try to pass this cost on to the customer. You've probably seen signs like 2% extra for card payments. This is called surcharging. But it's important to note that surcharging is not legal in all countries and is frowned upon by some card networks. Regulatory impact on MDR. In many countries, regulators have placed a cap on MDR to promote digital payments. For example, in India, MDR for debit cards is capped at 0.9%, with lower caps for small merchants. UPI transactions currently have zero MDR to encourage widespread adoption. For RuPay debit cards, the MDR is either zero or minimal to promote domestic schemes. In the EU, the interchange fee regulation, IFR, caps interchange fees at 0.3% for credit cards, 0.2% for debit cards. In the US, interchange fees are not capped, but there's growing pressure to regulate them due to rising merchant costs. Revenue models in payments. Let's step back and look at the broader revenue streams in the payment ecosystem beyond just MDR. Interchange revenue, earned by issuing banks on every transaction. Float and interest income. Credit card issuers earn interest on revolving balances and float on settled funds. Value-added services. Processors and gateways earn revenue through fraud detection, tokenization, loyalty programs, and data analytics. Setup and SaaS fees. Payment gateways charge setup fees, monthly SaaS subscriptions, and transaction-based APIs. Hardware sales. For in-store merchants, terminals and QR devices are monetized through rentals or sales. Data monetization. Aggregated and anonymized transaction data is sold or used for insights. Cross-border and FX fees. International transactions generate additional revenue through foreign exchange margins and cross-border fees. Cost of MDR to stakeholders. Let's flip the lens. While MDR generates revenue, it also comes at a cost. For merchants, it eats into profit margins, especially in low-margin sectors like groceries or fuel. For banks, fraud liability and chargebacks can reduce net income from interchange. For networks, infrastructure, risk systems, and brand trust require ongoing investment. For consumers, although not directly charged, the cost of MDR is often built into product pricing. Future of MDR. We're seeing a few trends globally. Compression of MDR. With increasing regulatory pressure and merchant lobbying, MDRs are getting squeezed, especially for debit and domestic cards. Zero MDR movements. UPI in India is a prime example of how digital payments are being made free at the point of use, funded by alternate revenue models. Dynamic MDR pricing. Some processors are introducing AI-based dynamic pricing depending on risk, time of day, merchant profile, etc. BNPL and MDR. Buy now, pay later services charge merchants MDR-like fees, often higher than traditional cards, in exchange for instant consumer approval. Open banking. As account-to-account, a 2A payments gain traction, they promise lower MDRs or flat fees by bypassing card networks entirely. Understanding MDR is fundamental to understanding how digital payments work as a business, not just as a service. Whether you're building a fintech product, managing a merchant account, or investing in payments infrastructure, knowing how value is captured and shared is critical. In the next chapter, we'll look at risk management, chargebacks, and fraud in card transactions, and how the ecosystem handles trust in a trustless world. Until then, keep questioning, keep learning.